All right, let's dive right in. Welcome to today's Explainer, where we're going on a mission to unpack some seriously eye-opening concepts from Chapter 2 of Keith Fitchen's Building Reliable Trading Systems. Now, if you've ever dabbled in system development, you know the dream, right? You build a trading system, you test it on historical data, and it looks flawless. On paper, you're an absolute genius. But then, you turn it on, you start trading with real money, and suddenly that perfect system just hemorrhages cash in the real world. So today, we're going to discover exactly why that happens, and much more importantly, how you can actually survive real-time reality. This brings us to a really universal pain point. Why do these perfect backtests just totally fail when real money is on the line? I mean, it is incredibly frustrating to watch a supposedly flawless system collapse. And honestly, the root of the problem usually comes down to human nature: greed. We all want to trade something that generates massive, life-changing returns. So when we're developing a system, we naturally just keep tweaking the rules. We keep adding little conditions here and there just to make that past profitability look bigger and bigger. We rationalize the risks because, well, the hypothetical reward looks so sweet. But by chasing that perfect past performance, we fall into a very, very dangerous trap. Meet the primary villain of algorithmic trading: curve fitting. Let's explain this in plain, simple English. Curve fitting happens when you develop a trading strategy using way too few trades in your testing data. Because you just don't have enough data points, you end up tweaking your rules so heavily that they perfectly fit the specific random quirks of that past data. You aren't discovering some universal market truth. Actually, scratch that, you're literally just memorizing the past. There is just a massive gap between expectation and reality here. Think of it like getting a custom suit tailored. But instead of the tailor measuring you while you stand naturally, they measure you while you're frozen in one very specific, highly awkward pose, okay? The suit fits that exact pose perfectly, but the second you try to actually walk down the street in the real world, the suit rips to shreds. That is exactly what a curve-fit trading system does. It was tailored for just one specific past scenario. This is such a widespread issue, mainly because of the tools we use. Keith Fitchen hits the nail on the head in the book, noting, "The system development packages you can buy are almost universally tied to the one-chart paradigm." Think about what that actually means. You open your software. You load up a single chart for a single asset, say Apple stock, or maybe gold, and you build your entire strategy based purely on that one chart. Listen, even if you find a few hundred trades on that single chart, it is almost never enough data to prevent you from heavily curve fitting. You are basically looking at the entire financial world through a tiny little keyhole. Let's look at a really simple example from the book to see how easily this happens. Imagine the Swiss franc back in the 1980s. It was a market that just trended beautifully. So you decide to build a simple system using a moving average, which, just smooths out price data over a certain number of days. Here are the steps. Step 1, check the average price. Step 2, if it's higher today, buy. Step 3, if it drops, short. Now, if you only test this on that narrow 1980s Swiss franc data, you'll just keep tweaking that end day number. Maybe it's 10 days, maybe it's 40 days, until you find the exact magic number that produced the biggest historical profit. Boom, you've just curve fit your system. Okay, so if curve fitting is the ultimate villain, how do we defeat it? The answer is our next topic, the sample size weapon. To really grasp this, let's use a super relatable analogy. I want you to visually imagine a giant overflowing barrel full of socks. You reach in and you pull out exactly 30 socks. You count them up, you have exactly 15 black socks and 15 white socks. Based on that small sample of 30, you'd probably feel pretty confident that the entire barrel is filled half with black socks and half with white socks, right? Well, here is the reality check. Your computer monitor can display over 65,000 true colors. What if that barrel actually has a few socks of every single possible color? Your tiny sample of 30 polls completely hid the truth from you. You wouldn't even know all those other colors existed until you drew tens of thousands of times. The takeaway? Small samples completely lie to you. So if small samples completely obscure the truth and a single chart only gives us a tiny sample, how on earth do we measure true performance? How do we know if our trading system is actually good or if we just pulled out a lucky handful of black and white socks? Well, to answer that, we have to pivot from the sock analogy directly into our ultimate statistical weapon, standard error. Let's establish a baseline of truth here: $100. I want you to imagine we have a magical, perfect trading system, and we somehow have access to an infinite amount of data, a literal infinite distribution of trades, and across all of infinity, The true, exact average profit per trade is exactly $100. That is reality. That is the absolute truth of the system. But watch what happens when we don't have infinite data. This illustrates what happens if we randomly select just 5 small samples, let's say 10 trades each, from that perfect system. Because the sample size is only 10 trades, the results wildly miss that true $100 average. One sample might show a massive profit. Another sample might show a terrible, crushing loss. This proves exactly why tiny sample sizes are a complete statistical illusion. If you build a system based on a small sample that just happened to spike up, you are going to get crushed when reality regresses back to the mean. And this is exactly why standard error is your shield against curve fitting. Now, I know the formula sounds intimidating, but it is really just simple math broken down into very small steps. Step 1, find the mean, or the average. Step 2, subtract that average from each result and square it. This just makes everything positive. Step 3, divide by the number of samples. And finally, step 4, find the square root. What this simple math actually does is measure how far your small sample is likely to deviate from the absolute truth. It literally tells you exactly how much you can't trust your own backtest. The bigger your sample size, the smaller your standard error becomes, and the closer your test actually gets to reality. And that is what you should really take away from all this. We've connected the dots here. The expectation of easy wealth through backtesting is a trap. It's a trap built on tiny data samples and the one-chart paradigm. If you want to survive the markets, you absolutely have to treat the real-time reality. Mastering standard error and demanding massive sample sizes isn't just some nice-to-have math concept. It is literally the only way to build a robust system that won't rip apart the moment you try to walk in it. So, I'm going to leave you with this provocative question to ponder today. Look at your own strategies. Look at your own charts. Are your trading profits actually real, or are they just a trick of the data? Are you looking at the whole colorful barrel, or did you just pull a few lucky white socks? Take these concepts, go interrogate your own backtests, and start developing systems that are actually built for reality. Thanks so